Yeah, we are moving right along in our programming. Very excited for our next panel, and love the ordinals panel. I'm a big ordinal lover myself, as you can imagine. So the next panel that we have here is stable coins on BTC Global Economics moving to Bitcoin. This is going to be moderated once again by Glassy. Glassy, please make your way to the stage. And we have Sid from BIMA. We have Dante from Ducat. And we have Michael Kelly, PhD, from Binghamton University. I do know where that is. So let's get all these lovely folks up on stage, and we're going to continue talking about assets on chain. Let's go. Glassy, here you go.
Sir, it's like those, I don't know if anyone else remembers WrestleMania, the beautiful tag team, tag your opponent or tag your teammate in, take care of the ring. That's exactly what's going on here. Some extremely smooth brains up here on stage with me, so.
No grooves.
Did you want to? Okay, that's fine. Great. And we have a wonderful addition into the panel. So what I'll do is just let everyone do a nice little introduction. Feel free to take your time. Give a little background on what you've been up to, and then we'll get into some more specific dialogue around stables, different strategies, why are they important. We'll definitely touch on some things around compliance, institutional adoption, but I think there's some really novel and distinct different strategies on here, up here on stage. So Sid, would love for you to kick it off, give a little introduction, and tell them about BIMA.
Yeah, guys, thanks everyone. Appreciate it. Yeah, I'm Sid from BIMA. We're creating a way for you to borrow against different types of Bitcoin liquidity. It's going to be super essential. I think the layer 2 landscape has been a war, and we're really trying to do exactly that, is literally sell to all sides. And I think one of the biggest things you're seeing is everything that you're seeing in this kind of a war, there's been 3 necessities for a layer 2 in these liquidity ecosystems. It's a DEX, it's an Oracle, it's a bridge. I think now you're going to need a stable. You know, we have another stable project, actually 2 other stable projects here as well. We're really, we're focused more so on kind of being a full stack service for your Bitcoin. Think of us less as a stable, more of like a on-chain hedge fund for your Bitcoin. So super excited to be here.
Hey everybody, I'm Dante from Ducat. Like BIMA over here, we are able to take the MakerDAO model from Ethereum and bring it over to Bitcoin. So what you can think of this as is taking your native BTC and unlocking liquidity from this and providing the channels, whether it's moving through layer 2s, whether it's moving with miners, essentially taking that BTC as equity and unlocking liquidity.
Hey guys, I'm Yogi. We're building Mezzo. We're a Bitcoin app chain built on TBDC. Also looking at the stablecoin model with MUSD and how you can unlock BTC as a collateral asset with an app chain model.
Well, if I was a marketing person, or if I was in business in general, I would use some pretty vicious psychological tricks because it's not that hard to convince people. If you can convince people, because the last panel somebody said, human nature is just human nature. It's a great example. If I was on a board, a corporate board, I would take that example and rip it apart, and it gets to my point of who I am. That if you can convince people that something historical, something constructed, is actually universal and permanent and has no flaws in it, it's just the way things are, you can really rip them off. So I'm a professor of Bitcoin studies and a historian at Binghamton University in New York. We run, I think, the only Bitcoin studies program in the US. We have almost 100 students in Bitcoin studies. We're mining on campus. We run a lot of mining experiments, node scaling, and DeFi, and Web3 digital humanities. I'm also a senior fellow at the Bitcoin Policy Institute in DC, which is a policy think tank advocating for Bitcoin. And with stablecoins, we are experimenting with a number of different ways to create stablecoins in our lab on campus, and I'll leave it at that.
Beautiful. All right, so we got a little sense of who's up here on stage. Now we can get a little deeper into the projects, and maybe we'll just start with like inspiration. Like why even start? Like of all the projects you could have picked, of all the different directions that you could have gone in, why a stablecoin? Like what does that unlock, and why do we need one on Bitcoin?
Yeah, so it's a funny story for BIMA, but BIMA was actually born in Vegas. So BTC Vegas, I will definitely be saying that a lot more. But I used to work for Tim Draper, and I think he's been a great evangelist for the Bitcoin brand. And I got into the space because of Bitcoin back in 2018, and I've been here ever since. But the reason why a stable has been very simple. It's you want to denominate your assets in some sort of store of wealth that can enable you to kind of grow with it, right? So I was hanging out in Vegas with Tim. He took everyone to go, gamble. It was the first time I ever gambled in my life, so it was nice. He gave everyone $100 to go and play blackjack, and he wanted some carry on whatever he would give or whatever. But that's just him. But I was just chilling with him at the Vegas airport. We were getting ready to head back to San Jose. And he got a Lego for his grandkid from this vending machine, right? This is the Lego vending machines. I got one for myself because I was like, I'm a kid at heart, of course, I still am. But the biggest thing I was sitting there with him, and for as long as I've known Tim, the biggest thing I was wanting to understand from him is, what do you actually do with your Bitcoin holdings? And he says nothing, and I was like, why? I mean, don't get me wrong, he comes from a very long line of wealthy people. And he's good with money. He doesn't need any more. But $3 billion, well, don't make me look at the Bitcoin prices today, but $3 billion, let's just see your market there, of Bitcoin is incredible. And I think one of the biggest things I chatted with him is like, well, Tim, you don't want to pay tax. You don't want to go through these different types of administration loopholes. Why don't you just borrow against your Bitcoin? Why don't you just go to a bank and borrow against your Bitcoin? And Tim is known for his eyebrows, right? So like the eyebrows kind of peek up and you see the light bulb over his head. It's like, okay. But he said, I probably would never want to do it through a bank. And that's what I was like, okay, maybe that's what I built. So that was the genesis for BIMA, was just like, Tim has always wanted to do a lot of things with Bitcoin, make a fund with Bitcoin, invest in startups with Bitcoin. 2013, he used to invest in startups with Bitcoin before the SEC said no. I'm pretty sure he's very happy this week with all the no action letters being issued. But that's BIMA's really a love letter to Bitcoin and the sort of idea with Tim and the Draper thesis. Borrow against your Bitcoin and use it for yield. It's very simple.
Sounds great. Anything you want to add to that, Dante?
No, I mean, we're running a very similar CDP model. So the importance of the CDP model is, like you said, like taking a loan against your Bitcoin, it's just much more capital efficient. I think, right now with what we've seen with Tether and Circle is like they've really, taken over the market with one-to-one denominations. But with that being said, like if we're going to have Bitcoin DeFi, like Sid said, you need oracles, you need bridges, and you're going to need stable coins. So one of the things that's going to be important in the market, just like it was in DeFi on ETH, is a decentralized stablecoin. So decentralized stablecoins are going to be just as important, I think, for people on DeFi as in people that just want to borrow against their Bitcoin. I think something that's just really interesting as well is like the whole security model of when you're allowed to borrow against your Bitcoin as a miner, you are now changing the dynamics of selling Bitcoin, whether it's a good market or a bad market, to pay for your operational costs. If you now can just take a loan and not have to pay the capital gains tax against it, it just opens up new market dynamics that I think are very important for Bitcoin as a whole, as well as retail users that are just not interested in selling Bitcoin to maybe pay for their groceries or whatever it is that they need that week.
I should add really quickly, that's a really important thing you said, which is that you don't want to ever give up custody or upside. There was a guy that bought a pizza back in the day for 10,000 Bitcoin, and I'm sure he's kicking himself in the ass right now just thinking, what the hell did I just do? That's why borrowing is super important. Borrowing is just these stables are a way for you to be able to make short-term liquidity while maintaining long-term upside.
He needed BIMA or Ducat.
Yeah, he needed us. He needed us. He needed all of us, man. We should have been born like 13 years earlier.
Yeah, fair enough. So I'd love to just craft up a slight deviation of that question or variant for you specifically. In building Mezzo, I know we've seen over the last year and really over many years of experiments with L2s. I would love to hear a little bit about like the strategy and the unlocks for building an L2, but specifically after having something so significant and well adopted like TBTC. And like what kind of advantages does that bring to Mezzo, and what kind of advantages does that bring maybe to the Bitcoin ecosystem as a whole?
Yeah, I think to take a step back, like Thesis, we're a venture studio. We've been building on Bitcoin for 10 years. We've been kind of thinking about the whole stack, like how do we get, the basic premise has been how do we get Bitcoin participation in the general economy to grow? And so we have Fold, which is a Bitcoin rewards card in the US. So you can kind of think of that as like an on-off ramp with like, we're in 48 out of 50 states. It may have improved. I don't remember. And then, TBDC was the big move, in 2020 on like how do we bring Bitcoin to the EVM side? Like the DeFi economy is booming. This, today, I don't think it's 2 trillion anymore. The market's down, but 1.5 trillion, wherever the number is. It's a massive asset that Sid and my colleague here has kind of talked about. Like, it's just sitting on the side. How do we have that participate more? And with TBDC, we saw, right, evolution can happen here, but less than 1% of Bitcoin is on chain today. And so with Meso, is like, how do we build an economy that basically allows people to kind of align incentives and have it participate more? I haven't looked at the data recently, but about 6 months ago, we looked at WBTC on ETH, and roughly 70% hadn't moved. Like, it just sat there. And so if you think about like commodity wrapped assets of Bitcoin on chain, they typically just sit there, and it's a really bad business. It's one reason why you see WBTC now go to BitGlobal, and there's without velocity, it's not a good business. You're not making money on the AUM. And so as we thought about Meso, it's like, all right, we have TBDC, we're on 8 chains, we have a bunch of announcements coming in the next couple of months on like how we want to get TBDC on multiple assets. For us, it's it's the most trustless way to go from native Bitcoin to on-chain Bitcoin on the EVM side without any KYC AML. You can go in and out. It's all trustless. And Meso was like, all right, how do we build an economy around this so it actually participates, and you have an ecosystem aligned around that. On ETH, you saw staked ETH, stablecoins, and all that stuff grow. So Meso was our version of like, how do we build a chain on top of TBDC where you can have it participate? And then one of the big use cases, as everyone on this panel is kind of like aligned on, is that stablecoins are the #1 product market fit that we've seen in the world so far, minus like Bitcoin itself. And so, buy now, like borrow now, pay never. Like, idea is that Bitcoin's going to continue to go up. Don't want to spend, what was it, 100 million on a pizza?
1 billion.
1 billion on a pizza. And so that's kind of how we've been thinking about it. And so Meso is our version of like, all right, we have the off ramps on the fiat side. We have TBDC that connects everyone, and Meso becomes like that on-chain Bitcoin bank.
It sounds like pretty sound logic to me. Yeah, love it. Michael, I would love for you to like weigh in. Maybe feel free to disrupt.
Any specific question?
I do. Yeah, I would
any
say
way
like
to anticipate what I'm going to talk about.
I would say either A, feel free to disrupt and bring up some challenging opinions if you'd like, or if you'd like to shine a light onto some of your theories and ideas for like an entirely different way of addressing a stablecoin. I would say in either direction or both.
So there's a few different types of stablecoins we've been working on in the lab, but I'll disrupt a little bit first. It's just to think about, like, why would we need a layer 1 stablecoin in the first place? Right? Why would I want a stablecoin as a rune when effectively I'm locking in or borrowing against my Bitcoin to spend other Bitcoin? I'm spending Bitcoin in those transactions. So but there are other bigger issues with using runes or using anything else on layer 1. And it goes back to, sorry to be the academic side of me, but there's a great book after the fall of the Soviet Union written that's called Everything Was Forever Until It Was No More. And it's the same idea with digital matter theory and ordinals theory. As long as we all believe it's real and that all these inscriptions are real and have value, it's all great. But as soon as things that we thought were universal, we realize they're historical, like that there are 2 genders and that those are somehow real, or identities are real, or anything else is forever. They're all constructions, and once we realize that, then everything else collapses. All the things you thought were actually coins are now just, sats, which is fine. They're still sats. So these are some of the conceptual matters and concerns I would have of generally building with that. But what we try to build and what we're trying to build is a few things. One is for different reasons. Like, one is that's all to say I still love runes. I still love all that and so on. But so I built the first rune that was backed by precious metal a long time ago, like back in May. It's backed by silver, and it's backed by, I call it fiat, so former fiat, so basically old coins, numismatics. So you basically collect old coins that people can lock their coins that are made of silver and gold, and then you get, in the aggregate of the collection, you get the stable value, or we'll say stable value is the value of the silver in the collection, or the value of the gold in the collection, that is locked in a museum or other public archives. So you bring coins that would otherwise be in the private space to the public to see, research, while also giving liquidity to people who have coins, and you have something, actual money that's, so ironically, what was fiat is now actually backing something like a real currency. So, and then with that, you also get an ordinal that is just a market value ordinal. The other one that we've been developing is in the lab on campus is a mempool stable coin. So history, I'm a historian, my PhD in history. The only thing history produces is data. Right? Past is not real. Past will never be real. It never has been real. History is real, but past is only an abstraction. And it doesn't matter if you're praying to God or you're using mathematics or you're mining Bitcoin. The only thing you're doing is connecting the abstract to the real and giving value to that process and its products. So within Bitcoin itself, there's so much data in the mempools that you can use different ways to create a stable to the data in there. Or you can make a wild casino. But if you look at certain data per block, like expected certain data versus actual certain data that is mined in the block, you can just peg right to that and create a stable using a decentralized oracle, which is another topic we could discuss on how to do that. The other one is a real-world asset coin that we developed with the Jewish community because I'm in Judaic studies. I work a lot with the Jewish community. We built something called Bitcoin shekel. We're still building it out. But it's backed by real-world assets and something called the kibbutz in Israel. And it's a very unique structure, community, where you don't have to rely on the state for the assets. And anyway, so those are the things we're experimenting with.
Wonderful. See, there's just so many dimensions. Like you think stablecoin, oh yeah, USDT, I know that story, you know, we know how that plays out. And so this leads me into my next question. Where do you get the audacity to build a stablecoin when there is a USDT with so much liquidity? Like how do you think about, or how did you think about addressing that maybe in the earlier days, or even now with the momentum that you're gathering? So I guess to the earlier stage, like how do you think about gathering that early liquidity? What are some of the unique maybe characteristics of what you're building that you think will be that big attraction mechanism? So that's maybe to you guys. And then I would love to hear from maybe a little bit of from the later stage, how you expect to continue to grow that. And maybe if you could bring us back to some of the early days, how you just went about even getting to the incredible size that you have.
You're asking why did we get the audacity for the stable. You should ask Morpho and Aave where they got the audacity to charge 13 to 22% APYs for borrowing against Bitcoin. That's really where the issue is with Tether and these different types of paradigms. Tether was focused on exchange liquidity first before DeFi. And because of that, the cost of capital increased for them to actually enable healthy rates for borrowing and lending. Imagine if you're trying to borrow against your home and you're paying 22% interest rate. Yeah, you wouldn't live there, exactly. I think that's why CDPs like us are extremely important, since we are the native issuer of the asset. Of course, USDT is very important for exchange liquidity. You need to redeem it for something real. And as much as real as USDT is, you want to basically create that sort of connectivity to, how close is it to cash? USDT is the closest to cash. And that's really what people want to do in the space still, is we're in a transitory period with these new stables, but there's a market for us because the audacity is with USDT and USDC as well. You talk to any of these L2s, you can talk to Mezzo, about how hard is it to get USDC and USDT in volumes onto their L2. Good luck. They're expensive. They're Web2 SaaS companies with a token around them. And I think that's where stables come super important, because now, rather than having a backing from assets that they would need to pull out of there, they bring the LSTs, they bring the actual liquidity of Bitcoin, and collateralize it to borrow a position. So it's sort of like that Uber game, like you see so many different types of these kinds of markets with gig economies appear because they're cheaper than Uber. And people go for them because they're cheaper than Uber. But then what happens after they hit scale? They become more expensive than Uber. So I think the great thing about this is it's a longevity game, right? So you look at the incumbents and the OGs, the stable market is going to be extremely rampant. And there are going to be several winners in the space. I don't think that there's going to be, everyone said there's going to be one stable coin, but then they're like, okay, USDT or USDC. I'm like, well, that's two winners right there. It's the fintech market. A small slice of the pie is still going to be a very tasty slice. So I think it has less to do with minting and everything to do with borrowing.
Yeah, and to add on to that, I mean, you really touched on like the network effects that come like from like the liquidity that like Circle and Tether can provide. But like when you're looking at what's going on right now, like in the current market, you could basically say that like Circle is going to become like basically a quasi CBDC. Like if you're not like complying with what the U.S. standards are, they can push you out. And you know, we've already seen how like the government works with big tech over the past 10 years. And if you don't think that's going to happen when they're working tightly with Circle, then I would be very, very surprised, and would definitely say that you should definitely take a look at what they've done with other big tech companies. So I think when it comes to CBDCs, CDPs, it's really taking a look at like financial censorship and giving people the opportunity to be able to stable up regardless of who is saying they can and cannot. Because you know the government, depending on which administration is going to be in, is going to say maybe they favor some people versus unfavoring others. So you know, maybe the centralized market has definitely figured itself out with Circle and Tether, but to not have a decentralized market would be a pretty big mistake, especially with the whole reason this industry exists is like the cypherpunks ideal of like privacy and you know, being able to stand up to authoritarian style governments.
Beautiful answers.
Yeah, I think from my perspective, I think you guys kind of touched on everything. The cost of capital is really high with Tether. Even if you go to an exchange, it's roughly like 6 to 8%. And that's, you know, high for an asset that's generally pretty underutilized if you're borrowing against BTC. I think the second thing is, I think the space is pretty ripe for disruption. So you're seeing a lot of other stablecoins just purely compete with Tether and Circle. Because if you think about it, like they're more capitally efficient. They're, you know, backed by treasury and other assets, and so there's yield and all that native stuff. When it comes to CDPs, you know, they won't inherently be as capitally efficient, but it's just tapping into a larger collateral pool. And the other thing is that people want trust and transparency. And so if you remember, like the Circle DPEG about 2 years ago, you know, people were worried like if it was backed. And like most of us that know how it's, you know, set up generally is going to worry, but if you're able to see stuff on chain and look at the exact outstanding debt and what your asset's backed by, the CDPs provide that. And I think, and also being able to do it in a 24/7 trustless fashion on chain, I think is something that a lot of people want and desire. And I think the last part is that there's not going to be a winner take all because there's very niche use cases for what people want to do with their capital and how they're going to use it. And so I think for us, it's kind of like thinking about that side of the market instead of like trying to compete with Tether, because I could see a lot of our like people that we're talking to, like, you know, they'll borrow against their Bitcoin, issue MUSD, you know, take that to Tether and then off ramp and do whatever they're going to do with it. But I think it's just that flow of capital and how it works. And Tether also just has, you know, 10 years plus on the market right now. They have the most entrenched on-off ramps globally. They have the exchange relationships, and they have a lot of syncs. So,
Beautiful answers. Did you want to weigh in on that too, Michael? Or yeah,
You can handle more of it.
I can handle it. That's why we invited you up here.
Well, I think, not to be the academic again, but there's this philosopher.
You're the resident academic. Like,
Yeah, well, there's another one here. There's a philosopher today, Cornel West, and he always says that there are too many echoes and not enough voices. And I feel the same thing happens a lot in Bitcoin and talking about Bitcoin's addressable market and the $2 trillion and so on. But if I was an investor, I would be very concerned about any company building a stablecoin or in DeFi that is not vertically integrated. Because we talk about decentralization. The fact is, that's a lie, right? I mean, two companies alone, who may be actually working together, control almost more than 50% of the mining. If the government goes to, I won't name them, but the government goes to one of them and says, hey, stop allowing op return data, then anything built on op return data is not going to get through regularly. Sometimes it will. Other people will mine blocks elsewhere in the world, but it won't be consistent, and then everything will get backed up. And so if a company is building that is not mining, that is not creating their own mempools and their own templates and their own operating systems and their control boards and everything from the ground up, and then also promoting that and understanding that and educating people in that, then they're setting themselves up for, well, just becoming Circle or Tether, which is just more, corporations and can be shut down I might as well just move over to Ripple at that point, I guess. Yeah, those are my thoughts.
Nice, thank you for that. Kind of touching on something that you mentioned, and also thinking back to like in the 90s and the even early 2000s, there was this, I would call it a phenomena. There was like this explosion of a thing that was known as complementary currencies. And economic developers were using this as a tool to keep the dollar spending more times in a specific geography, in a city or in a main street, so that people would come, they would trade their dollars, their US fiat dollars, for essentially what is a coupon that could be spent and redeemed in this geography. And there was a crazy proliferation during this time. During these like 20 years, then it started, there was a few, and next thing you know, there's thousands of these, because they're proving effective, and they're proving that they could actually generate up to 14 times the spend on that dollar locally by doing those kind of things. Do you think that we're in this place where we'll see so many, like an explosion of stablecoins, even to the point of maybe individual companies wanting their own stablecoin? Is that maybe a direction that we'll see?
Can I just hit just 1 second? Why not do that? Why not have a network state of local stables, and every community has their own stable built on that? But anyways, yeah.
I think it would happen, but at some point, like, why?
Yeah.
Like, it's just not capitally efficient for everyone to launch their own stablecoin. Like, I think it's just pretty stupid. Because you have everyone.
Well, I guess the why would be so they could make extra capital instead of taking $1 to pay their employees, instead of taking $1 to whatever, pay their entire supply chain or whatever it is.
So I could see someone doing like a SaaS model where they leverage up, like M0 Labs is kind of doing this, like they're providing like the underlying infra to support a variety of stablecoin issuers. But at some point, I think it doesn't make as much sense. I do agree that we're going to see an explosion of stablecoins. I think a lot of people are looking at it. If you've looked at the stablecoin bill currently being discussed in DC, they're putting together clear guidelines of any company that's over 10 billion and any company under 10 billion, and like having that debate of like, how does this work? How do we allow innovation while also controlling like the systemic risk that could be present with so many issuers? But it kind of comes back to, then you need to build a market for interoperability between different stablecoins, and how does that go to fiat? And the amount of infra that needs to be built, although the fixed costs I think will start adding up a little bit, where then I still see like a duopoly or oligopoly or of the off-ramp side. Like you could have, thousands of stables on chain. Like we've had, I think 20 to 30 in just our like last couple of years. Like Paxos had one, True USD. Sure, I'm missing a ton, DAI obviously, and there's like a ton of those algorithmic ones, but I think it just gets difficult. I don't know. I don't have a.
I saw something else with your analogy with the complementary currencies. I thought there was about LRTs and receipt tokens. If I'm giving my stable for some sort of a yield generating opportunity and I get some sort of receipt token that I can use and spend in other places, that's a proliferation. I think that's more. I think the receipt token side of this, because there's a lot of stablecoin staking that's taking place. I put in USBD, I get it out. SUSBD or USDE, SUSDE, whatever it may be. It's really that one-to-one representative for the yield, but enables more kind of proliferation for that use. So I think, no, I don't think there's going to be a huge, it's like you see a lot of stable coins right now, sure, but how many are actually going to scale and survive? Because keep in mind, each and every single stable coin is going to need to have the same headaches that all of us have gone through. How do we get exchange liquidity? How do we enable DEX liquidity? How do we enable regular utility? How do we actually enable someone who's going to pay this? Who's the market, they're going to... So at some point, you're going to really understand that it's better to just use USDC and USDT and, whatever emerges out in these markets, because stable coins are going to have use cases, right? Like I would say that my stable coins use case is an easy way to borrow against Bitcoin. That's the easiest way to kind of describe what a stablecoin is. But some other stablecoins that exist out there might be an RWA stable, right? But basically, it's just really finding different ways to collateralize different assets to push them out. So I think I see more of a market coming with these kinds of receipt tokens and LRTs off of stables, because I think that's what's really going to attract a lot of different types of investment managers, because that's one thing that was so great about the stable that you cannot do with the dollar, right? Or rather at scale. If I am my mother or father and I give my money to my, 529, that money is there. If I give my dollar to a strategy and get a receipt token, I can loop that receipt token. So there's a way that you could use you mentioned abstract and values, right? I think that's the entire thing. What are the values that you are basically applying to these receipt tokens to create these proliferations of strategies. Now, there's a very fine line between doing that and whatever the hell happened at Lehman Brothers in 2008. So there's a degree of risk that you need to be comfortable with, because the moment one of those things, the main stable or whatever, is gone, it's a trigger event that destroys everything. So I would say that there are use cases that are yet to be explored, but I don't think one, it doesn't make sense, and two, good luck. Having a stablecoin for everybody isn't going to be necessary.
Yeah, it's not really how we've seen network effects take place anywhere in software, so I don't think it's going to happen here either. Like, you'll normally see a duopoly in most software products, and so I think where stablecoins maybe you'll see more than just Circle and Tether is because of, like has been said, like real-world assets or CDPs, however you want it. So maybe there's like 10 or 11 or 12, but I don't see there being a massive economy of 1,000 different stablecoins. It just doesn't really make sense from the perspective of also just attention. People, first of all, are nervous about crypto, and when you are trying to convince them of something new, there's always going to be put your fingers in your ears. So where there's more liquidity, there's going to be more trust, and where there's going to be more trust, it's going to start the flywheel of like, okay, people use maybe this stable coin or that stable coin, but when you give people too many options, like how many people do you know use a ride service outside of Uber or Lyft? I have no idea. Apple, Samsung, Google, Bing. I mean, maybe DuckDuckGo, but like, there's not too many outside of.
Yeah, there's like 4 cloud service providers
Yeah,
that people think
exactly.
of, right? There's Azure, AWS, Google, et cetera. And I think the other thing is that,
There's a concentration of the masses.
yeah, because it's efficiency, right? Like
Yeah.
that's where the moat happens. Like that is where you've scaled up to a point where you can provide a better product at scale. For the end person, it needs to be easy and accessible.
It becomes a natural
Yeah.
monopoly.
Yeah, this reminds me of .com. It's like you have pets.com kinds of stables, and then you got the Amazon kind of stables. It's like you are going to have thousands of these kinds of things, but how many are actually going to be there for the longevity? And I think that's the biggest issue that the BTC5 space and just regular Web3 space has in general. We are not longevity focused. We have the fastest liquidity accelerations for any of our tokens. We have the fastest hands. We trade 365 days a year. We live 10 years within the span of a year. And I mean, past 2 days, exactly. You can see Bitcoin dropping, and I've lived like 3 different lifetimes. Like looking at the prices, just that just there. So, yes, there will be a period of flourishing, but then there's natural selection.
Well said. I really appreciate you guys for being up here and just bringing in so much just devastatingly accurate and well said points on these different subjects. I think we're kind of coming towards the end of this panel, but I would love to give every one of you an opportunity to maybe, do you want to give some alpha or some updates on what you're doing, maybe calls to action, any of those kind of things?
Yeah, for all like 40 people who are here, maybe less, but I would love if you guys could, follow BIMA BTC on Twitter. Feel free to follow me. Testnet is live. We're ready with everything. Mainnet soon, so get excited for that. I think you're going to really love the product. And yeah, please follow us on Twitter and engage. Thanks, guys.
Yeah, thank you everybody for coming. Thanks for everybody up on the stage too. It's been awesome, being up here with you guys. We just launched our V2 testnet, so for anybody that's out there, from V1 to V2, we've basically opened it up so anybody can, go ahead and play around on our app. That's app.ducatprotocol.com. Give it a go, and yeah, thank you all for being here.
I'm excited about Bitcoin, so stay frosty.
In true fashion, I'll just leave by giving you an assignment. If you
Dude, I
could,
graduated last year. Don't do this, please.
Shit.
if anybody could run this data and find for me how much Bitcoin of all is actually deployable into DeFi, when you consider that most Bitcoin holders are maxis that will never use it in DeFi, that's the majority of Bitcoin. And then you have another million or so lost. And then you have millions more that are being promised to be held by states for all sorts of geopolitical reasons. How much actually can be addressable and that you could convince people to use? That's what I'd like you to find. And if you find it, email it to me, send it to me. Telegram, I guess, BitStorian. The easiest way to find me is the Bitcoin Policy Institute, and look up my name, or just my first name in my university. I'm told I'm the first result on Google, so I don't know how. But anyways, yeah, thanks again.
Thank you, everyone.
Beautiful. Thank you so much.
Bye.